One loan approval stands between you and your dream home. Watch this video to make sure you don't leave that approval to chance. Mustika everyone, I'm Georgina, a qualified loan expert and co-founder at Estra Finance here in the Philippines. We create these videos to ensure Filipinos are equipped to make the most informed financial decisions and help turn their dreams into a reality. In today's video, we're focusing on a topic that can be quite stressful for most people, getting your loan approved. We're going to pull back the curtain and show you what banks are really looking for in a borrower. Trust me, by the end of this video, you'll have the inside scoop on how to present yourself as a low-risk candidate that banks will actually want to lend to. So stick around because the next few minutes could make all the difference in turning that loan application into a resounding approved. This topic is quite big, so this is part one of a two-part video, and part two is going to be released next week. One of the best ways to get approved for a home loan is to figure out what might make a bank say no to you. If you know what might make a bank worried, you can fix these issues before you even apply for a loan. So what are they looking for? Firstly, job stability is a big deal for banks. If you haven't been at your current job for at least 2 years, or if you didn't have a long-term role in your previous job, you're already on shaky ground. Banks are looking for stability, a predictable income stream from their borrowers. Speaking of income, here's another term you should get familiar with, the debt-to-income ratio. Banks will calculate your existing debts and the loan you're applying for against your income. If your debts outweigh your income too much, expect to get rejected. But don't worry, we'll discuss this later in the video. Another important thing to know is that your bank will check what is called your credit report. Your credit report shows all the money you've borrowed, like home loans, personal loans, and credit cards, and how well you've paid them back. It helps lenders decide if they want to lend you more money. If you have anything negative in here, like unpaid loans or multiple missed payments, it can really hurt your chances of getting approved. Also, in your credit report is your credit score. This is a number that tells you how well you've been handling your debts, like your credit cards or any other loans that you may have. It's like a grade for your financial behavior. The higher the score, the better. Nowadays, more and more banks are starting to adopt this score as a lending criteria you must pass, and they are checking your credit score through agencies like TransUnion. If you don't meet the minimum number, that's another tick in the cons column for your application. Luckily, this score is quite low, meaning you would have to have a really awful, terrible, no good credit history in order to be declined on this factor alone. Another thing banks look at is your history with the bank itself. If you've been careless with your accounts with them, such as overdrawing your debit accounts, not paying back credit cards on time, or you have a messy history paying back previous loans, you're less likely to get approved. Banks have long memories when it comes to how well or how poorly you've managed accounts with them. Some other red flags for banks include having outstanding payments on your debts, any cancelled credit cards, and severe negative marks like home foreclosures or car repossessions on your credit report. Feeling a little overwhelmed hearing all this? Don't be. Services like Estra Finance can assess your financial situation and help you find banks that are more likely to approve your loans. They can even guide you in fixing some of these issues that could result in a declined application. So yes, while these are the things that might get your loan rejected, understanding them means you're already on the path to making yourself a more appealing borrower. Alright, moving on to a big topic that could make or break your loan application, your income. Yes, how much money you make is a huge factor in whether the bank gives you that thumbs up. Let's talk about some quick hacks to boost that income figure on your application. First up, consider adding a co-borrower, but the banks don't let you just pick anybody. It has to be an immediate family member or a spouse. Some banks will also approve fiancés. But most importantly, make sure your co-borrower actually helps the situation. Their income should be solid and they should owe less money than they make. If they're drowning in debt, that will backfire on you. For instance, if you add a co-borrower who makes 50,000 pesos a month but owes 60,000 pesos a month in debts, that's not going to help you at all. It's only going to hurt your income. Make sure you choose wisely. Next, try to take note of the timing of your application, especially if you earn performance-based commissions at certain times of the year. Banks usually look at your last 3 months of pay, sometimes only 2, to figure out how much you make. So try to apply when your commission is reflected in your most recent payslips. But, and this is a big but, not all income is treated the same. Sometimes banks only count part of things like performance-based commissions or overtime. They might only use 50% of that money when they're doing their math. So before you apply, ask the bank how they're going to calculate all your income. not just your full-time job. You don't want any surprises later on. And speaking of overtime, if you can snag some extra hours at work in the 3 months leading up to your application, go for it. It could give your income numbers a little bump that could make a big difference. Now, don't forget, you can add other income sources as well. We're talking regular salary, commissions, bonuses, overtime, remittances, even money from renting out a property or earnings from shares. The more money you can show that you have, the better. So if you've got other income, always ask the bank if you can use it. One last piece of advice from us is to ask for a raise at your current job. Now, I know this can be nerve-wracking, but if you've been doing great work and you haven't seen a bump in your paycheck, it might be time to speak up. If you do get that raise, just make sure to wait to apply so that the raise is reflected in all your most recent pay slips. Alright, so those are my tips on the ways to increase your income. Please keep in mind with these hacks that the more income you have, the higher amount you can borrow from the bank, but the more you'll have to pay back long term. So don't go crazy with these hacks, just be realistic about what you can afford. Next thing that we need to talk about is your total debt ratio. If you don't know what this is, it's a financial metric used by banks to assess your ability to manage monthly payments and repay loans. It's expressed as a percentage and calculated by taking your total monthly debt payments and dividing them by your total monthly gross income. So if your income is 50,000 pesos per month and your total debt, this includes your current debts and the new monthly amortization of the loan you'll be getting from the bank, equals 20,000 pesos, then your total debt ratio would be around 40%. It's important to know this as banks use this calculation to dictate if you have the capacity to pay off your new home loan with your current debts and income. Now, banks also have a cap on how high this ratio can go. So how high is too high? Most banks like to see a total debt ratio between 30 and 50%. If you go over that percentage, it likely means your loan is going to get declined. But remember, every bank is different, so check with what your target bank prefers. Now, there are other factors that affect your total debt ratio, like how much your loan amount is, how much down payment you're putting down, how long your loan term is. We'll get into the nitty-gritty details of total debt ratio in another video. A quick side note, some banks even count your rent as a debt in this equation. So if you're paying a lot in rent, this could really impact your TDR. So before you fill out any loan application forms, take a moment to calculate your TDR. It could be the key to getting your loan approved. Another key strategy to boost your chances of getting that loan approved is to put down a bigger down payment than what's typically required, which is usually 20% of the property value. Let's break down why. First off, your down payment directly impacts how much you need to borrow. So more money upfront means you're asking the bank for less money. This is a huge factor because it could lower your total debt ratio, which we just talked about earlier. So if you're sitting at a 60% total debt ratio, which is above what the banks will typically allow, to lower this, you could increase your down payment, which will lower your monthly amortization and lower your total debt ratio number. Secondly, when you offer up a larger down payment, you're essentially telling the bank, hey, I'm a safe bet because I'm great with money and I have lots of it. Banks face less risk when you borrow less, and they absolutely love it when they see you're able to give more money upfront. So to sum it up, a higher down payment can help you in two ways. It makes you look better when the bank calculates your TDR, and it shows the bank that you're a serious low-risk borrower. Okay, let's talk about another crucial tip, knowing your borrowing limit and staying under it. You don't want to bite off more than you can chew, as this can be a surefire way to get your application rejected. One of the best ways to ensure you're not borrowing too much is to use the total debt ratio formula we gave you earlier and playing around with a mortgage amortization calculator on any bank's website to ensure you're keeping under the total debt ratio limits of 30 to 50%. Figuring out your own borrowing capacity can be very tricky. There are a lot of variables to consider, like your income, existing debts, your credit score, and so on. So if you're unsure about how to calculate it, you might want to consider talking to a loan specialist. As mentioned earlier, how long you've been at your job plays a huge role in whether a bank will lend you money. Banks love stability. A steady job indicates that you have a regular income stream, making you a less risky borrower. Most banks will want to see at least 2 years of stable employment. Now, 2 years doesn't always have to mean that you've been at your current job for that long. Some banks will be more flexible. They'll look at your total work history, adding up your time at different jobs to hit that magic 2-year number. Other banks might require you to have 2 years straight working working history with your current employer, or at the very least, your previous one. You might wonder why this 2-year mark is so crucial. Well, it gives banks confidence that you're not a flight risk, that you've got your career and your finances somewhat figured out. They feel more reassured that you'll be able to pay back your loan repayments on time. If you're job hopping or thinking about a career change, you might want to hold off until after your loan is approved and after you've signed all documents. It seems like common sense, but it's often overlooked. You need to pay your debts on time. Yes, it sounds simple, but you'd be surprised at how many people actually trip up here. Banks love people who pay their debts on time. Timely payments tell the bank that you're responsible and you can manage your finances well. On the flip side, having a bad track record with payments is one of the quickest ways to get your loan application tossed into the no pile. Unpaid loans or even just consistently late payments can be a huge red flag. If a bank sees that you're not great at paying back what you owe, they're going to be less inclined to give you more money. It's that simple. Please note that when I say debts, I'm talking about any loans like an auto loan, personal loan, installment loans from shops like Benson's, other mortgages. I'm also talking about credit cards in this instance as well. So if you've got any existing debts, make sure you're keeping up with them. Even if it's just the minimum payment, make sure it's done on time every time. Remember, every payment you make on time is a step closer to making yourself look like a dream borrower in the eyes of the bank. And that's what we're aiming here for. Alright guys, now let's get into something that sounds a bit silly but actually works. Make your bank your friend. Yes, your relationship with your bank can actually matter a lot when you're applying for a loan. Think of your bank like a friend you're asking to borrow money from. You want to be on their good side, right? There are 2 main ways you can get friend points from your bank. Having a good track record of helping a healthy daily balance in your accounts. In fact, if you have enough savings with certain banks, they may even give you a discount on your interest rate. And making all your repayments on any cards or loans you have with that bank. Now let's talk about the flip side of these. Just as a good relationship can help you, a bad one can absolutely hurt your chances as well. Things like having frequent overdrafts, bouncing checks, mishandling your credit cards, and not paying your loans with that bank can throw cold water on your loan application pretty quickly. So the lesson here, keep it clean. Sweeten up your bank before asking it for a big favor like a loan. Okay, that's a wrap for part 1 of how to increase your chances of getting approved. Stay tuned as part 2 will be coming out soon. Before we end the video, I'd just like to mention 2 things. Firstly, if you're in the real estate industry and you've got clients who could use a loan specialist, we'd love to work with you to help your clients find the best financing for their situation. Estra Finance has a great referral program with uncapped commissions, so please sign up to our referral program using the link below. Secondly, if you're a potential home buyer and you're looking for some expert guidance from before you start buying your home to getting your loan approved to refinancing your home to get a second one, we're here to help. So check out our website and jump on our list using the link below. We will be reaching out to every single one of you on launch day, so make sure you get in early. And that's a wrap on that. Please show your support with a like, comment, and subscribe to the channel. Ingat!